Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn Associates with your financial market wrap-up. And this is for Monday, the 4th of February, 2019, just after 3:20 p.m. Central Standard Time. So this will be the closing price in the stock indices, and boy, they just don't stop. Google's earnings came out. The company fell about 2.5–3% initially after it. Don't know what it's doing now that it's a few minutes later, but interesting to see. And what you've got to be looking at in a number of these companies is their forward guidance too. That's very important. Suffice to say, tomorrow is the State of the Union speech by the president. But more important, you've got to keep this in your mind, that by Friday, they have to have a plan in Congress if they're going to include border wall funding or not. You'll say why, and that's because by the time you have to print up what's being proposed over the weekend, deliver it to the members of Congress, they have to get together for their vote. They either get this thing done by that time, and the president will probably be able to see it at that point, and he'll know what he's doing. So does he pull the plug first and declare a national emergency to get funding and end up in a court battle? Does he wait to see what they're going to do and then do it after the fact? We'll find out. There's no way to second guess this man, so I'm not going to try to. Stock market likes what it's seeing, though, as the general group of earnings coming out. The dollar, surprisingly, keeps rallying. The interest rate sector, as you can see, holding on right here, but creeping up in real rates. On the energy sector, if you read over the weekend, they'd have you believe that crude was going to soar because we saw a reduction in oil rigs, and we also see the Venezuelan situation. The opposite happened. The market actually slipped back a little bit. So when we come over now to this market and we look at the S&P, the market has had a vertical price rise coming from Christmas Day. That's when it really happened. Take a look at this from 24.85, and here the market is up roughly 200 points, 240 points. It's a pretty big rally. It's 10% rally if you think it through. We then get over to how the market looks on the charts. We've had a bit of consolidation, and you can say that I think that's consolidation, and the market's trying to lift itself out of that as we're going on. The pattern is still one of higher lows, higher highs. That's what I define as an uptrend. To break it, you'd have to take out 26, 22, 25, and the way the market finished today, even if that happened in one swoop in a day, you would have a higher high, lower low. So you need a different chart pattern for that to occur. Where's the battleground now? The 100-day average of closes. 3 days in a row, we have been up to this zone, and that's where the market is stalling, if you will. And I know we're up 16 points, don't get me wrong. But as you come back on the chart, you can see what I'm getting at. So as we approach this last Thursday, we hit it on Friday, we're pushing on it today. What about the Bollinger Band? It's just above the market right here at the 27-24 zone. So if you get from here into that number, I'd be a little bit careful. I mean, now you're getting in between the 100-day average and the upper Bollinger Band, and as a chartist, that's all I care about. These are layers of resistance in the market. In terms of momentum, notice what's going on. Both numbers are over 80. What were they on Friday? Both numbers over 80. What about the day before? Both over 80, and even the day before. That's called an embedded reading. What often happens on the momentum indicator called, it's actually an oscillator called slow stochastics, is I've discovered over the years it can convert. It can lock in bear trends, lock in bull trends. When you lose the trend, it's often accompanied by the red line getting over, when it's under it, a 20 reading after spending several days or more under that. So when you get that, it's often, not always, often a sign that price and the 18-day average want to come together. A lot of people don't believe that. I hang my hat on it. I like this indicator. And you can see. So now that you're bullish embedded, there's no reason for me to be bearish, as you can see it looking at this, until that red line's back under 80. So it's systems go on the buy side, not on the sell side. When you come to the NASDAQ, do we have that same indicator here? Well, both numbers are over 80 today. They were over 80 on Friday, not on Thursday. It's not embedded. It needs another strong day tomorrow. Similar to what we just saw in the S&P, you're now 3 days in a row between the Bollinger Band, the 100-day average of closes. If you get a pop here, a very important average of the 200-day is this deep gray one right up here that I'd be looking for the next resistance point. In the Dow, you got over today the 200-day and the 100-day, but not the upper Bollinger Band. They've grouped together as a resistance zone. Is there any reason to be short? No, you've got the embedded reading, and as long as you keep that embedded reading, my friends, there is no reason not to do anything but do what? Be bullish. Now here you lost that reading, and I want to take you back to Tuesday. The rule is you can lose it one day, you've got to immediately gain it back, and then you got a trap sprung. That's exactly what occurred, and the market has been working off that trap ever since. In the Russell, you've kept the embedded reading. So I'm a broken record. There's only one side of this market that I've liked, and that's the bull side. But all of these indices are in the key resistance zones, and there might be some money coming off the table tomorrow in front of the State of the Union. I don't know. When I come to the VIX, I decided to compress the chart because I wanted to show you. This is the area back here from last summer. And if you look at the peak, you were in the 15 or 14 area, back and forth in this sideways action. And that's what this market is now falling back into. But the combination of embedded reading in the stock indices, what about a bearish embedded reading here? Both numbers are under 20 today. Both were under 20 on Friday, both under 20 on Thursday, not on Wednesday. You embedded today. So for me to say, the market's going to do something different, you've got to lose that red line back over 20. Another thing that I think is happening is that I wouldn't be surprised if certain pros are stepping into this market here and they're writing puts, not calls, puts, and saying that because you're back into that support, each time you've hit this lower Bollinger Band, you seem to get back to that 18-day average area in fairly quick note. Would be interesting to see if they've done that. In the bond market, you still have the pattern of higher lows, higher highs, but what's really going on is the market's narrowing in its trading range as defined by the black dashed lines, the Bollinger Bands. Momentum is down. Bias is down because you closed under the 18-day average, trend up. The market is waiting to see what the next leg of this market is. Same thing's true of the 10-year notes. Notice how formidable the resistance was here. And again, the first move backs to that 18-day average is the market trying to figure out what next. TLT threw out a bad signal today. It broke down, got under a previous low. So now you got a higher high, lower low. You're out of the trend. The bias is down and momentum is down. In the dollar index, battleground right here, right now. For the bears to win, they cannot let the market get over 95.69 in my opinion, and they need to get under today's low. If they do that, I'd say they try to jump on the market. Let's assume that they don't and they lose out. You get over 95.69. I'd have a pattern of a lower low, higher high. Not an uptrend, but certainly out of the downtrend. In the eurocurrency, it's an attempt at being bullish. Higher lows, higher highs. The close, however, wasn't ideal in that the market is going to finish under the 18-day average of closes. I realize it's just by 3 ticks, but it still loses the upside bias. If you take out 114.51, it's a flip-flop of the dollar. You have a higher high, lower low. What'll be annoying for that is so many traders are looking to catch a trend in these currencies, and they're just not offering longer-term stable trends, and they often do. Currencies are really a phenomenal market. In the British pound, when you lose an embedded reading, I teach that price and the 18-day average try to come together. Now, if you look right here, all the numbers are over 80, and they stayed that way for several days. Once you lose that, just like you are here, Momentum often leads price, and it leads to the market trying to work lower back to the key moving average, the 18-day average of closes. In the Japanese yen, you've reached a downside important target, the lower Bollinger Band. That doesn't mean you can't go lower, but now you've got an oversold market that hasn't been trending anyway. It's got a higher high, lower low. I don't know that going to be a lot of pressing on it one way or the other. In Bitcoin, you lost the bearish embedded reading, which often leads to price in the 18-day average trying to get together. We'll see if that happens. In the crude, I think a lot of people were surprised today. You know, over Friday, we saw the rig count drop rather sharply, according to Baker Hughes. If you were watching the news on Venezuela, you would think that you get even stronger markets. You haven't gotten back over the 18-day average differential of April Brent versus the WTI crude. And you keep getting to this upper Bollinger Band and stalling. The question is, why are we stalling? I think a lot of people are looking for the breakout, saying we're losing Venezuelan oil, we're losing oil rigs in the U.S., that should be blah, blah, blah. Well, the chart action is one where you're in resistance. That's what's going on. If you can clear this in an overbought condition, can you run to the 18-day average? That number from where we're at, $6 higher, it's a 10% move. I don't know, but that's one of the things I would imagine traders are looking at. You're overbought in the WTI into the resistance. You've been fighting it 3 days in a row. If you can get a pop in this market and clear it, and obviously if the government fell in Venezuela, I don't know which way that would carry the market, but who knows? Would you be able to make a run there to the 59.20 level? Possible. Gasoline, trying to base out. Here's what's exciting. This is the way markets develop big trends. They narrow in over time. These Bollinger Bands come together, and all of a sudden you get a pop in them. Nat gas still punishing people that played that polar vortex to lift it. It didn't in the mild weathers here, so the market's making new lows, but it is oversold, getting very close to a Bollinger Band bottom. So, one of the things I look at when I look at financial markets happens to be seasonality. Now let me define what seasonality is, defined by the Moore Research. They go back with their database, and their database looks back in time and says that, gee, on a cash basis or on a futures basis, does both. On a certain day, the market tends to rally up until this other day, and if you followed it each year, here's the percentages that it's worked year after year. They drop anything that I think didn't work 13 out of 15 years. You wouldn't think there's that many that have done that. Then they show the average gain and loss per day. Now let me give you the one thing. I got this here for a reason. You would think you can just play that and you got your winning hand. It doesn't work that way. There's a reason you go from 100% reliability down to 93, down to 80, and all of a sudden it's gone. This is a tool. It is not the Bible. It is going to be right. It is going to be wrong. It's just telling you what has happened in the past history. And like everything else, past performance is not necessarily an indicator of future performance. It's a tool. And you use these tools at different times because different things in world economies take place over and over at certain points. So you look for them, you look at the chart action, you try to put it together. I'll let you judge. How do I use it? Well, number one, I pay for it just like you do. I want you to know this is not a paid advertisement, just another tool that we have. If you'd like a 2-week trial, we work with them. Give us a call. You can go to our website, sign up for it. Be happy to get it for you. You can click up here. I'm Ira Epstein. You have a good day, and I will talk to you all tomorrow.